Learning how to do it, folks. She's learning how to do it.
Welcome, everybody. You all are starting to
All right, it's
pile
good to have
in.
you on here.
Yes, we are so excited for tonight. Ryan's a little bit nervous, and he knows it's because we're going to roast him, you guys, and I can't wait.
Roast. I mean, loaded with questions tonight, right?
Absolutely. This is awesome. So excited to see you guys. In fact, I got to look on here and see those of you. Let's see. Oh, yes, Carl, Christian. Oh, my goodness. Dan, Danielle, Gary. It's so good to have you guys on.
Sounds like you know all these folks, Melissa, huh?
Well, I do. A lot of them are our investors.
All right.
So we're so excited to have you guys on. We're still having people trickle in, but you know what? We're going to get started. We want to jump in and be able to have time to answer as many questions as we possibly can. So before we dive into what it is that we're going over today, I want to remind you guys, we want to answer your questions. So if you have a certain question that you're wanting to get answered, please make sure to put it in the Q&A section. Obviously, we want you guys to stay engaged and communicate in the chat as always. However, it's easier for us to accommodate the questions if they're in the Q&A space. So again, question, put it in the Q&A, but still stay engaged in that chat box. So just to make sure you guys know what I'm talking about, we would love to see you in there. See Steve and Sandy, they already put it in there. Ryan, you're going to do great.
I love it.
So as you guys know, today we are going to be going over underwriting. And as we know, it's not just about running the numbers. It's not the most enjoyable thing to do. Ryan, don't kill me for saying that.
I would beg to differ. There's a lot of enjoyable things in this industry, right?
Okay, we're going to leave that part to him, which is why he's one of the most respected underwriters in the industry. It's one of the most important part of any and all deals, and it's exactly why we are incredibly lucky to have Ryan on our team and who's in charge of making sure that the underwriting on our deals are accurate and conservative and all of the things that we're going to be discussing today. So I'll introduce him a little bit, although I know that the majority of you already know him and are familiar with his background. But Ryan actually grew up watching his granddad acquire apartments. And I believe, correct me if I'm wrong, Ryan, is it in California?
Sacramento, California, yep.
Nice. Okay, so that's what started him in this industry. And he has grown Multifamily Capital Partners into an extremely successful company. And we have a little over 2,200 units that Ryan controls as the managing partner. He also is the co-founder of the Multifamily Mindset, where we mentor and help entrepreneurs really understand this industry. And as you guys know, Ryan is extremely giving. So it's exactly what he's going to do tonight. Just like he does in the Multifamily Mindset, he is constantly giving to our students who are just in this space. And so, Ryan, we're excited to have you. We're excited to have you share your knowledge. Yes. So Ryan, I'm going to turn the time over to you. I know that I plan on roasting you with all of the questions that my investors have with underwriting. Hope you're prepared.
Listen, I expect you to interject as much as possible, right? You know, so I mean, Melissa's right, guys. You know, I'm extremely nervous. I typically don't get on and do these, but you know, it's good to be on here. So you know, we get a lot of questions regarding, why did we start the fund? Why, how do we get to 44%? This is really about due diligence, within a deal and for investors, and why should you get into a deal? One of the questions we've had in previous webinars we've done is, guys, there's no joke, right? People say, why do you put on a webinar? Why are you doing this? There's, you can see it right here, the MF Akahi funds. Now, what's Akahi stand for, Melissa?
One.
It's our first fund that we're doing, and so, with that, people start funds for a reason. They have to have a track record. And what is that track record? Melissa just went through some of those things. 2,300 units, a little over 230 million, I think 80 million in equity created. Clearly we've done a pretty good job at the track record thus far. I would say one of the best accomplishments we have is our annual rate of return, right? It's at 44%, and so a lot of people go, man, that's awesome. We have deals all over the place. Some of our deals have cash flowed well. Some of them have amazing equity. For those of you who have invested in our deals, you've participated in that. In fact, Melissa, we're selling off 4 properties in a portfolio in South Carolina, which, the annual rate of return ranges from 30% all the way up to roughly 60%. And so we're super proud of that. But you can imagine some of our investors have asked, hey, how do I get from the 30% to the 60%, annual rate of return deals? And that's a beautiful thing with doing the fund. And so tonight we're going to talk about, how did MF Capital Partners get to 44% annual rate of return? And how can each of you that are not currently in the fund join us in the fund and get on a phone call with Melissa to invest with us? So let's kind of go over that. One of the biggest things in talking to, and like Melissa said, anytime you guys want, throw out questions, more than willing to answer those as we go through this tonight.
But before you dive in, Ryan, I just want to point out, this is what's so great about Ryan is he's willing to say, hey, I want to show you exactly what the underwriting and the metrics we look at to get at 44%. Most operators are like, oh, the transparency isn't quite as there. And so I want to recognize that Ryan is extremely open and wants the investor to truly understand what it takes for us to have a 44% track record. So thank you, Ryan. Thank you for being willing.
Yeah, I think the question, and I was on a webinar the other night, and one of the questions, yeah, believe it or not, Melissa, I was on a webinar the other night too. So I'm getting out there a little bit more, but
I love it.
One of the questions that was asked is, sure, 44% is great, but over what amount of time, right? Is that over 2 years, 3 years, 5 years, 10 years? And I think the impressive number in that is that most of our properties are about 2.5 years where you're realizing that 44%, and so, one of the things that we kind of laugh about in the industry is, you see a lot of operators out there, and for our investors, we want you guys to do your due diligence, which is important why we're talking here is, we passively invest in deals. We passively invest in every single one of our deals. And one of the biggest things that people look at is, what that overall return is going to be, and so what I find amazing is a lot of people, when they look at the deals at first, will see a 27% annual rate of return. And they go, hey, Melissa, why aren't you guys doing these deals that are 26, 27, 30% annual rate of return? I want to go invest in that. Well, I've been asked that same question. And
wait, let's ask our attendees. If you would invest in a deal that shows 27% ARR, let's see a thumbs up. Let's raise your hand. Let's see. Cindy says she's in. Flower hour. I love it. Why not? Gene. Yeah. I saw your attitude in that answer. I love that.
Everyone sign me up. I'm in. Now
Osmond says way too high for initial numbers, which leads us into.
Yeah, I mean, the thing I look at is if I were to take a couple deals, right? And I think the investor at first, right, may look at the 27% return and they go, hey, look, I'm going to take that all day. Where, our fund that we're promoting, Melissa, what is the average range that we look at?
So the average, you mean the rent growth?
The annual rate of return, right? Our what we're promoting is 18 to 20%.
Yep.
Well, it's like, holy shit, right? What do I do, right? 18 to 20%. Hell no, I'm going with the 27% annual rate of return, right? But the reality is when I look at that, and at first, when I first started investing, I probably would have done the same thing. One of the first questions I ask is, how long are you holding the investment for, right? And a lot of these, you'll see that they're going to hold it 8 to 10 years, right? 8 to 10 years that they're holding, these for, right? Man, if we promoted 10-year holds, we could get ours up there every single time, right? Every single time. But more importantly, like I said, we were going to talk about how are we getting 44% over 2.5 years? So I would encourage you, anytime you're looking at an investment, is ask that question, right? How many years are you doing it over? One of the biggest ways that we do is this. we focus on B and C properties. You see a lot of properties out there. I guess let me ask this question, Melissa. How many of you out there are looking for pretty properties? You want a good looking property, or are you looking for maybe something that needs to be fixed up? I would love to see that response on here.
I really hope that everyone was like me when I first was in this industry, because Ryan showed me a picture once of a property that we were looking into. I was like, Ryan, I would never live there, ever. I would never live there. That is ugly.
Value add properties, right? That's what we're looking for. We're looking for value add propities. Garrett just said it right there.
Yep.
Someone put, warts and toes and problems. Problems are good, right? Here's the thing. You see a lot of operators out there currently right now who are promoting on Facebook, right? It's a great thing with marketing is they're promoting these good looking properties. But when you really dive in and you look at the underwriting on them, these properties aren't cash flowing for 7, 8, 9, 10 years, right? I want to focus on, our portfolio I talked about in the Carolinas we're selling that we mentioned. It's, ranges from 30 to 60% annual rate of return. I was joking with one of our investors the other day and they said, hey, listen, my son went out to look at one of these properties and not ours, but they were looking at a different property. And he said, man, he didn't want to, he didn't want to do the deal because of the property. And I said, man, if you looked at some of our properties, you would probably run, right? You'd probably run from these properties. But the reality is, right? Do you look at a property? Do you look at the numbers? We look at the numbers, right? What can we do to improve the property, right? How can we increase the overall rents, right? And how can we decrease the expenses? Here's the reality, guys, is when we were looking at doing this fund, we were looking at A properties. Why? Because when we show them to you as investors, you look at that. That's the first thing you look at, right? Listen, I think that I might be maybe a 7 on a scale of good looks, right? But holy hell, I think I have a good personality that takes me to a 10, right? I tell you this, is I look at the same way as a property, right? I want to get a 6 or a 7 in a property, but man, behind that, those numbers are strong, right? The people are paying their, they're paying their rents, right? They love the community. But more importantly, some of the things that we look at are properties that are mismanaged. So I want to tell you about, some of the properties we're currently exiting right now that are in our portfolio we're selling. And I also want to talk about some of the deals that we're doing right now that are going to be in this fund. Those deals we're doing are closing in the next 3 weeks. So for those of you who have not invested yet or talked to Melissa and her team, right, I would encourage you. In fact, Jackson, you can throw the link up there. And for those of you interested in investing with us, especially, by the end, man, click on that link and get with these girls and they can go over those investments. But some of the properties that we've done is, going into Tropical Ridge, for example, that's in Columbia, South Carolina. And I remember at first looking at this deal going, oh man, it's going to take a lot. Well, we bought this property at about $7.5 million. And I remember we brought our management team in there and they were like, man, it's a tough market. Columbia's tough. The rents are tough. People, delinquency is typically high here. And we went in there and said, no, listen, we've got a strong management team. We can go in. Well, we had a regional manager who was new to us. We'd been with this management company for 4 or 5 years, Melissa, right? Mm-hmm. And so we had a new regional manager. And you can imagine having that, we have to set the tone. So one of the reasons why we have success is we set the tone. We don't let the management company do it. We set it, right? We stick to our business plan. We stick to the underwriting and we tell them what to do, right? So we went into this property, and when a management company goes in, raising the rents about $50, that's good for them, right? They're raising rent, they're doing their job, right? And I remember the regional said, hey, listen, we just raised the rent on this unit $50. Well, they didn't discuss it with us first, right? And part of the thing that we do is we have an agreement with the management company. They have to disclose that to us first. So we went in and said, no, this is not what we're doing. We're raising it $250. Well, how are we going to do that? We're not just raising rent, we're improving the community, right? This place had awesome quarry rocks, is an awesome lake right in the middle. What did we do? We went and cleaned off, all that brush, from the previous owner. They didn't want to go there. This place was hideous, man. It was, but it had a gym in the middle of it. And we wanted to go in, we wanted to fix it up. And so for us, it's important to fix up those external factors, right? The exterior, right? Landscaping is huge to us, right? You want to, bring the people into these properties, and then we want to rent it out, but we want to improve the interior as well. And so we said, listen, trust us, we'll do it. So we fixed up a couple units, made them premium units. And guess what? 3 of the units rented out $250 above market where they were currently at right there, right? So how do we do that, right? That the property manager was at $50. We came in at $250 above what they thought. Well, I want you to think about, what does that do for you guys in this property, right? That $250, what did it represent to our investors? Well, that $250 was our 3-year and 4-year numbers that we were hitting because we were proactive in what we wanted to do, right? We set the tone with our property management company to be able to fix this, right? To be able to fix the problem. We knew what the property was worth. We knew what the units were worth. We knew what rents were going for in the surrounding areas, but we also knew that the surrounding properties didn't have the same property or same amenities that we had, right? And I would ask you this as investors, if you're treated correctly as a tenant, are you much more likely to pay a higher rent? I want you to think about that. If you're treated correctly and you're not treated as a number, would you pay higher rent?
No question.
Yeah, you absolutely would, right?
I want the community.
You want the community, right? So one of the things that I learned very quickly is, I would walk around these properties and I would let tenants talk to me, right? And it was very intriguing to me to find that these sellers, right, what their tenants were actually saying. And a lot of them were saying, don't move here, right? The electrical's out. They're not doing their work orders, right? I put a work order in and they didn't even do it, right? And what do? We go get a consensus in our properties and we fix these properties up, right? More importantly, we listen to the suggestions, of our tenants. One of the other properties we had is I remember flying out, maybe this is off topic, Melissa, but I remember going out and the manager was like, no, we can't
wait, Ryan, go off topic?
Listen,
no.
I think there was a squirrel, right? There's definitely a squirrel, right? But and maybe this is why I don't get on camera, right? I go off topic, but
we love it. Nope.
Yeah. So, I remember going to a property where the management said, hey, listen, it's the middle of COVID. I can't collect rents. I can't do that. And I remember going, walking, no one knew that, obviously that I'm an owner and, and I don't disclose that, and there's reasons I don't disclose that. But it was interesting. I see Daniel from North Carolina. Awesome. We have a lot of properties there in South Carolina. Good to have you on, Daniel. So, what's interesting is, walking around, hearing what the property manager said, hey, you don't want to talk to that person. You don't want to talk, oh, they don't pay their rent. Don't do this. Well, I remember walking by one of the people that one of the ladies, her name was Lacey. And Lacey said, you don't want to move here. And the manager came and got me and pulled me up. But you don't want to talk to her. She complains all the time. And I remember saying to her is like, well, hey, what's going on? What's wrong? Well, she took me into the unit. And within the unit, 2 of her electrical outlets didn't work. She had an extension cord that was going off to the side and around the corner to run it into the one electrical outlet in the front room that actually worked. Well, think about that, right? When people are visiting the property, what are they going to say? She's the first one of the first ones in the property that you look at. She's going to let everyone know how bad these properties are, And so going back to how do we get 44%? Man, one of the first things that we do is we we stabilize property, but how do we stabilize it? We've got to fix a lot of the problems that the current or that the former, seller didn't do, right? They might have lived out of state. They didn't visit the property. They got a management company that maybe didn't know what they were doing, or they weren't as popular in that specific market, right? Who knows what it might be? Maybe they didn't visit the property. Maybe they didn't ask questions, right? A lot of it is pride, pride that doesn't allow them to go in and fix up these properties. But by doing that, after a 6-month period of stabilizing properties or stabilizing these investments, we can now go in and we can start raising rents. We can start going in and raising the rent. Why? Because they have trust in us, right? How many of our tenants have gone to property management companies, Melissa, and given feedback to them, good or bad?
How many of the I was actually reading Doty's message.
You're reading the chats, right?
Yep. What did you just say? How often
do people go to our property management companies and compliment what we've done with the properties?
Oh, all the time. In fact, we had a student at one of our webinars, or not webinars, one of our conferences say, how impressed they were with their grandma actually lived at our apartment. Wasn't it Charbonneau, Ryan?
Yeah.
Yeah. And she mentioned, we had mentioned Charbonneau in the presentation. And then later, she pulled us aside and said, actually, my grandma lives at Charbonneau. And she has said the new management is amazing.
It's amazing, right? We get into these investments, obviously, with investors, not only to invest, to make a good return, right? But to improve the living or the quality of living that people live in, right? I truly believe that, as you put people first, right? That's a differentiator in why we're able to get some of the returns we're in. Not the only reason, right? I mean, obviously we find distressed properties or mismanaged properties of people that don't know how to do it, right? And then we go in and fix them up, but really we're not going after the A properties. We're going after C properties where people live, where, they need a place to live, right? They want something fixed up and they're willing to pay it if they can live in a good condition, It's interesting though, going back to I got to read my notes here, Melissa, right? I'm not as good as Tyler here. He's great on camera.
Hey, that's all right. You're doing great, right?
Yeah. So thank you. But, I want to ask you guys this is what is most important to you in deals, right? And I want to go into, obviously this fund, if going to the fund, is it cash flow or is it equity? Joanne, you're on here. Jesse's on here. And I know maybe what some of those answers are from existing investors. But what's the most important thing to you guys? Is it equity or is it cash flow? Different ones. Equity, cash flow. Both. I love that. Both. Right. I would agree. Right. Obviously, depending on where you're at in life, right? My grandfather had a ton of equity, right? A ton of equity. And when he passed away, he was able to pass it down to us. For us, for me, generational wealth is important, right? What my grandfather left to us is very important. I know to you as investors, getting into an investment, especially in today's market, is important, right? Track record is important. Not just what we say, right? But what we do. My brother's always saying, don't tell me, show me, right? And I know so many deals that we've looked at to passively invest with. It's a lot of talk, right? It's a lot of talk of what they do, and the returns aren't there, So one of the reasons we don't go to A properties is, listen, man, people that have been in our deals, like the portfolio we're selling off, they don't want to wait 7 years for cash flow. For those of you who said cash flow, you don't want to wait for 7 years. Our average, on the slide there, Melissa, what is our average cash flow right now?
There you go.
Awesome. 7.85 is what we projected. 12.65 is what we've done. Now let me talk about how do you get there, right? Those are just numbers to you guys right now, but how do we get there? The reality is when we go into a deal, we spend quite a bit of time underwriting. A lot of people have asked me this, Melissa, how many times do I underwrite a deal?
Oh man, constantly,
I
over and over and over again.
Numbers are running in my head. I think as Melissa has put business plans together for you guys, right? She's like, Ryan, you just redid it. Ryan, you just redid it. In fact, to the point where she's had to make copies to put off to the side, because I will continue to do it. When we take over a property, I will continue to underwrite. But I typically underwrite a deal about 40 times before it ever sees your eyes. 40 times. Now, a lot of people look at that and they go, why would you ever underwrite 40 times? Right? That's insane. For one deal, Osmond, for one deal, 40 times. Right? And that's no joke. Some might be 20 times, 25 times, 30. But the reality is this, right? If an investment doesn't go through, who are they going to question? They're going to go to the person who underwrote the deal, right? The person who came up with the numbers, right? That led them to get into this deal, right? So for me, right, I feel that I have a fiduciary responsibility to you as investors to put into our deal, your money to our deal, that you've entrusted us with your money to come in there, that I have spent the time to look at this. And what do I look for? Believe it or not, I look at, so many people when they invest in a deal, they want to know why the deal works. I want to know when I underwrite a deal, why this deal is not going to work. Right? I look at it a different way. right? How can I make this deal not work? Right? Not work. I'm going to tell you about a deal that's in the fund, right? That we're doing currently. You know, this deal is Coventry, right? It's Coventry. I think we're renaming it Brays Bayou, right? What a great catchy name, Brays Bayou. But Coventry is the name. It's in Houston, Texas, right? This deal, right? Underwrote at about 19%. 19%. I underwrote this deal 38 times. 38 times. This deal. Kid you not, 38 times. But why do I do that? When people look at the underwriting, they don't realize all the different aspects to it, right? Lending can be a part of that, right? The market rent growth. I want to touch base there really quick, right? This deal's in Houston, Texas. Would you guys agree that Texas is a great market to invest in right now? Absolutely. And if you say no, man, you hop on a call with me. I will set you straight. Texas in general is the #1 state to invest in the country, right? We currently have in the fund, we have 2 deals that will be out of the Houston market. Coventry is one of them, and Glenwood is another one. Glenwood, we just signed the LOI on it. We're in the middle with our attorneys in executing the PSA. So that one will come on the market here in the next 2 months. We'll be able to invest in that. But that deal is about 19.5% annual rate of return. Right. Well, why do I underwrite again? Let's go back to that. Why do I underwrite 38 times, Melissa? Well, I'm going to look at what the best potential, possibility is on this deal. What can we do if we hit every single metric? Do you think that I'm going to show that to you guys? Absolutely not. One of our biggest mottos is this, right? I want to underpromise and over-deliver. Okay. I don't want to go back to these operators we talked about earlier. Okay. And tell you you're going to get 27%. Because the one reason is this. If I told you that you were going to make 27% return on your money, 25% return on your money, every single one of you at the beginning said what? Yes, sign me up, put me into that deal. Well, guess what? I sell that deal off in 3 to 4 years and I hit 25%, 27%. You're going to say, great, right? But let me flip the script on you a little bit. What if I told you this deal that these 2 deals we had, in the fund, we're going to do 19%. I want to fast forward 3 years from now. Okay. And that deal now hits 44%. Who are you going to reinvest with? You, right? You, absolutely, right? Absolutely. 25% is still great. And you would probably reinvest, some money with them. But the reality is why? I'm going to ask you this, Melissa, right now. One of the metrics that we look at, there's 2 metrics that we'll look at is market rent growth. And then we look at obviously, taxes. Melissa brought this up earlier in some questions that we could potentially, have. And I asked her, what are some questions that investors have? But Melissa, what is the average rent growth in Houston currently right now?
12%.
12%, right? It ranges 10 to 12%. That's pretty good, right? You look 8 years ago, 9 years ago, rent growth really wasn't that. But what if I told you that Houston has grown astronomically over the last 7 years? Right? In fact, this is what gets me so excited about the Texas market, specifically Houston right now. Houston in the last year was right around 10.5, 11%, right? Some areas of Houston is right at 12%. Our properties are right in the area of around 12%. Here's the thing. We have a property that's currently we own that we closed on in December, where we have raised 14%, the rent growth in 14% in 6 months. 6 months. What does that represent to you guys? That represents 3 years of what's on our underwriting. So what does that mean? If we told you 19 to 20%, right, it is what we would average on an annual rate of return, but we hit 3-year numbers in a 6-month period. What does that mean?
That means that 38 times that you underwrote the deal is only mitigating our risk. Yeah.
But in that underwriting that we sent out to investors, the rent that we had in market rent growth was between 3 and 5%. Would you say that's conservative? Melissa, why did we not underwrite it at 12%?
Because we want to always over deliver. always, and we want to stay conservative.
Yeah, man. So many underwriting templates are not, I mean, when we passively have invested in previous deals and we've looked at their underwriting, you took a look at it and man, their market rent growth was at 10%. So no wonder they're hitting 27% or they're showing you guys 27%, right? Is that market rent growth? Is they're putting almost at the cap, right? Here's the thing. Could I underwrite the deal at 8, 9, 10% in rent growth? Absolutely, right? And guess what? About 5 of my underwriting, examples I've done are actually at those numbers. Why? I want to see the potential of this property, right? If we go in and we can control the property management company and we can direct them in the right way, we can fix the community, we can put it exactly the way we want. What can this property actually do, right? I want to see why, because we invest our own money alongside you guys, right? In fact, out of all the equity we put into each deal, we put about 10% of our own money into the deal, right? Now, when you hear that as investors, right? Each and every one of you that are going to invest in this fund, because I know you'll invest in this fund, but when you invest in the fund and you know that the operators are putting up to 10% of the equity into the deal as well, does that give you certainty or confidence in that investment as well?
Absolutely. Skin in the game, right? I'm not going to invest in anyone unless they have skin in the game.
I mean, here's the reality, guys. I'm 43 years old, right? There's a lot of gray hair. Someone told me, Melissa, someone told me I look 52 the other day, 52 years old.
It was not me.
The weight I put on. It was Melissa, the weight that I put on or the gray hairs, right? But, that's all right. I'll take the age, right? A lot of it I've learned from my grandfather. But the reality is this, right? Generational wealth is created by investing in investments like these, right? It's an investing in deals that are not only cash flowing, right? I know, Jesse, on here, cash flow is important to you. But I know that in previous deals you've gotten, right, the equity return is equally as important. Why? Because some of the investors I see that are on here have been able to take that equity and reinvested it with us to get a higher amount of cash flow, right? Equity, if done correctly, can generate more cash flow for you, right? So why is it important within this GP must have skin in the game? Absolutely, Dan. Absolutely. You see a lot of operators, Dan, probably you've seen that don't have skin in the game, right? That don't have skin in the game. But
so,
you see
Ryan,
it. Yep.
Oh, sorry. Go ahead and finish.
You go ahead.
I was just going to ask, I get asked this question all the time. If we're investing in Texas, how do we underrate the tax rate there? So I was hoping maybe you could explain that.
Yeah. You look at that. I just saw a question there. You can go over that here in a second. Tax rates, right? One of the biggest things the problems you find in deals is the operators that don't look at taxes, right? Do taxes increase? Unfortunately, they do, right? I live in Orlando. Messed up situation politically right now, right? But Disney, huge issue with Disney, right? Property taxes are going to go up, right? Here's the reality. Property taxes in Texas are reassessed every year, right? Every year. So here's the reality is there's a lot of operators that go out there and they don't reassess taxes. They don't put that into their underwriting. Well, what does that do to your investment? Well, let's say that you're cash flowing at 7% out of it, in the first year, maybe 7.5% in the second, middle of the first year or after the first year, year and a half into it. At the end of that, going into that second year, taxes are now reassessed and they double, right? Or at times, 1.5 times where it was. What's that going to do to your cash flow? Cash flow is going to go from 8% to about 2%, 3%. Man, what does that do for you as an investor, right? It takes a lot of trust away, right? A lot of trust away from what your cash flow is because it was not properly, underwritten at the beginning. Okay. The other thing is this, right? What do you do to proactively look at things? One of the things we pride ourselves as a group is we're constantly forecasting. We're constantly looking at solutions rather than the problem. Are taxes going to go up? Yeah. Do we account for that? Absolutely. But does that mean that we're not going to get our legal counsel to go in and protest taxes? So are you telling me you're not even 2 to 3 times my investment? Well, listen, I'm telling you, Daniel, if you can 3 times your investment, man, you show me that underwriting and I can definitely pick it right. 2 times, definitely, right? Most of our investments are about 2 times. So absolutely, right? 3 times, I actually saw an underwriting the other day of 3 times. right? And it wasn't even close. There's a lot of things that you can mislead on equity, on multiple or equity multiplier, right? On that. So, but Daniel, I'd be interested in talking to you after this. Who do you recommend to protest taxes? We have our legal counsel going to do it. There's several people in Texas that we use, but we go in and do it. A lot of these deals that are in the fund currently right now, challenge tax bill of the attorney. Absolutely, Dan. These deals that we're getting in right now, we talked about forecasting. What have we gone on and done in these deals that we're closing in 3 weeks? Well, May 15th was the deadline in Texas to be able to protest taxes. We already knew that we would close on these deals. We're closing in June 13th. But the thing is we already knew that we'd be past that point. So the reality is do we go in? Were we proactive? Is the seller going to necessarily protest those taxes? Probably not, right? They're going to sell it. They're going to leave it to us, but for us, we've done this long enough to know that we want to go in and protest those taxes and go down, right? Have them go down. Here's the thing. Did we account for taxes going up? Yes. But if we can take our legal counsel, we can take our attorneys to go in and protest those and pay a lesser amount than what we accounted for. Guess what? Now that 44% that we're talking about, lets us be a lot more achievable. Why? Because we accounted for that increase, but because of us being proactive, it is decreasing our expenses going out, which does what for your cash flow? It's going to increase that cash flow for you, right? Think about it. Wow. I mean, what a concept, right? You've got operators out there. It sounds like some of you guys have invested with other people, but you have operators out there that are not proactive. They don't go out and do it. The other thing is this, right? We getting back to market rent growth, Melissa, is, being proactive. Just because we underwrite conservatively doesn't mean that we stick to that all the time, right? So let's say that we underwrote it at 3 to 4, 5% in market rent growth. No, man, we're going to push that as hard as we can. In fact, one of the questions, Melissa, that someone posted on here is, what is your exit strategy? How do you take a look at that? Well, in the first 6 months that we take over a property, we go in and we stabilize that property. Like I said, right? We're going to do some research. We're going to send some people out. We're going to have secret shoppers that go out and they get that feedback from those investors, right? They don't know who they are, but they're giving that feedback. And what do? We go in and improve that. So we're stabilizing in the first 6 months to 8 months. During that 6 to 18 month period, we're doing exactly what we did on this property in Houston that we own, right? Is we're going in and we're ramping up those rents, to the point of exactly on these properties in Houston, we're seeing 3-year numbers in a 6 month period, right? How amazing is that? And so during that 6 to 18 month period, after, as that 18 month period approaches, what are we doing? We're looking forward. We're talking to lenders. We're talking to the market. We're seeing what's going on with the Federal Reserve, right? We're looking at what's going on with cap rates. Then we're looking and saying, okay, hey, look, if we can sell this property off today, what would the annual rate of return be to the investors, right? Believe it or not, we're always looking at what's important to you guys. That's why we asked the question, right? Obviously, we're promoting a fund tonight, right? There's no joke about that. I said that from the very beginning, right? In fact, Jackson, go throw that link back up there, right? See a lot of people asking what the minimum investment is. So the thing is Melissa, I just lost my train of thought. What was I talking about?
You were talking about how obviously we are raising for a fund. That's what we're here for.
Yeah. So I got you. So yeah, we're looking at the fund, right? And so we're always looking at exit. So this portfolio that we're selling off in the Carolinas, the longest that we've held one of those properties is less than 2 years. That's that property I was telling you about, that we raised it from where the property manager wanted to do $50 a month to $250 a month. $250 a month. That property in an 18-month period. I really want you to listen to this part. In an 18-month period, and I think that there's a couple investors I know that are on here that invested in that property. We bought it at $7.5 million, and we're selling it for $15.1, almost $15.2 million in an 18-month period. Like Danny, you asked about a 2 and 3 times equity multiplier. What is that? Well, it's not off the purchase price. It's not $7.5 million. We only raised $4 million for that deal. $4 million for that deal, right? You look at the equity on that, that's almost $7.5 million. It's almost double there, right? So it's almost a triple multiplier on that. It's about 2.5 times after fees are paid out. 2.5 times almost equity multiplier. Why? Because we forecasted, we looked at what was going on with the market, right? We ramped up rents. And at that 18-month period, we looked and said, hey, do we want to sell? And a lot of our investors, because I always follow up with John, follow up with Melissa, I follow up with Tasha and their team, right? And I asked them, what are the investors talking about right now? Are they happy, right? Do they have questions, And guess what? We told them, listen, this is what we can get in the market, right? We can sell it for this. Do you think that your investors would be happy with this? And Melissa will go out and do a poll and say, hey, listen, if we sold it right now, would you be happy with a 50% return on investment, which is exactly almost what that return is on that property? Would you be happy with that? Or on one of the other properties in the portfolio, would you be happy with a 30% annual rate of return if we sold it right now? One of the properties has been held for 8 months. We've owned it for 8 months. Would you be happy with a 30% annual rate of return on that property? Actually, that one's a little bit higher. That's a 30%. That's a 30% return in 8 months. So that's a little bit different.
Ryan, I have a question. So EJ wrote, does rent reflect the fluctuating tax rate?
What was the question?
Does rent reflect the fluctuating tax rate?
Does it reflect the fluctuating tax rate, right? Let me see that question. I want to see how it's written here. Who asked it?
EJ. It says, does rent reflect the fluctuating tax rate? And EJ, feel free to put in the chat what you wanted.
Yeah, you'd have to expand on that one.
We'll move on to the next one.
Yep.
Fabian wrote, how does MFCP account for down cycles? When a period of rent decreases after acquisition happens, how do you prepare for it beforehand?
Yeah, so you're talking about the inflation and deflation of what's going on in the market right now, right? Our rent's gonna maintain where they're at. This is exactly why we give a 6-month stabilization period. Okay. Now I want you to think about this. So many people focus on rents going up, and obviously that accounts for what our returns are, right? They they definitely account for the returns. I was talking to an operator and they said, Ryan, why do you care about expense ratio so much? And they said, if you raise the rents, the expense ratio will naturally go down. And they're right, it will. But guess what? If I can raise the rents and decrease expenses, how much quicker does that expense ratio go down? Right? And a lot of people don't look at it that way. I want to constantly drive my expenses down where I can, right? Where I can. And there's certain areas that we can do that in, yeah. What was the question again, Melissa, on that?
Let me go back. So the question was, how do we account for down cycles?
Yeah, so the down cycle, right? What are we looking at? Deflation. Does inflation scare you guys? Sure, right? If you're not with operators who are not experienced, here's the thing. When COVID came out, were a lot of our investors nervous? Absolutely, right? But once again, right? People pay rent based off the community they live in, right? Obviously, the markets that we go into, we look at job growth, right? Job growth is important. If job growth was down in a market that we would invest with, we would never invest there, right? And that's what's important to us with our investors, right? Is going in a market where the job growth is up. So let's say that came down and the market just went crazy like it is right now, right? I want you to think about this. There was a report that came out today and it talked about the residential housing market. They talked about, capital gains and the fear of capital gains. Well, what happens with the fear of capital gains? They're talking about that Biden wants to increase. Here's the thing, right? Do we talk politics in relation? In real estate? Absolutely. I'm not going to talk about who I like and who I don't like, but does politics play a part in real estate? Absolutely, they do, right? Biden wants to raise capital gains up to 39%. Okay, so from 20% to 39% from short term to long term, right? So what does that information that go out do to investors? Right? Freezes them. They don't want to sell their property because out of fear that they're going to have to pay more or they're going to sell a lot more. So what they're saying is that the housing market is not going to sell off. So there's going to be not as much supply out there, which means what? People aren't going to be able to buy houses. So if they don't buy houses, where do they move to? Move to apartments, right? They rent. That's exactly what they do, right? They rent. And so, what they're saying is that you look at any report out there, you look at Fortune magazine, Forbes magazine, you look at any of these magazines, which is what we do. We spend a lot of time each week doing research for you guys, right? What's going on with the market, and we forecast, so you look at the market and what's going on. they say more people are going to be renting and going to apartments than ever before, right? You look at HR Magazine came out and said that the Gen X, right, that the younger generation want to rent more, right? So people are concerned with deflation and they're concerned with inflation. They should be, right? But the reality is, what's the safest investment that you can do right now? What's the safest investment that you can do right now?
The stock market.
The Akahi fund, right? The Akahi fund, right? No, here's the thing. It's real estate, guys. It's multifamily. It's real estate. It's exactly. So the reality is this: are there going to be people that leave your property because rent may be too high? Yeah, that's just running a business, right? You can say Target. You may shop at Target, right? Some may shop at Walmart, right? Listen, some of the prices are a little bit higher at Target, right? The reality is, when we create a better brand, we create a better community, people will pay that rent, right? They're not as concerned, right, with a little less rent somewhere else. Now, some of them are, right? But more people want to live in a good family environment, right? Petro says some people, right? You're right, some people, but some people are going to leave, But the reality is, are rents still going up in Texas? Absolutely. Why? Because the demand is there. Why? Because people are leaving different states and they're flooding into Texas. That's exactly why it's the top market right now. You look in 2008, and whoever asked that question is the real estate market cyclical? Absolutely, it's cyclical, right? Historical data supports that, right? You can go to 89, you can go to 99, you can go to 2008. Guess what, right? You can look at, 2008, it was supposed to happen in 2018, 19, right? We're now in 2022. And guess what? The real estate market is still growing. Over the last 7 years, in the Houston market alone, it has grown a ton. In the Texas market alone, it's up 17.5% this last year. 17.5% this last year. One of the highest in the country, right? So getting with that, because I know we need to move on, right, is this. How do we get to 44%, guys? One of the things that we underpromise, we overdeliver, right? You've got a team of people here who are communicating with you. Like I said, there's a lot of our investors on here hoping that I'd screw up on this webinar, right? No, they want to see Ryan doesn't teach it all. Ryan just does underwriting. I'm the guy behind the scenes, right? Maybe they wanted to see what Ryan looks like on camera. Who knows? I'm joking. But the reality is, we spend a lot of time forecasting. We spend a lot of time looking to see what your investment can do. We talked about 2.5 years. If you could get a total return, right, of 60, 70% in a 2-year period, right? Would you rather go with that? And I want you to think about that tonight, right? As Jackson put up the schedule, the Calendly invite, and he put up the link for, to invest in the Akahi fund. I see there's 10, 20 of you guys that have asked, how can you invest in it? The thing is this, if you could invest, after a 2-year period and see some of the returns that we're seeing and averaging 44% annual rate of return, right? Who do you want to invest with? Do you want to invest with the individual who is doing market rent growth at 8 and 10% and 12% at the top of the market? Or do you want to invest, with the operators out there like us who are at 3, 4, 5% in their underwriting, right? In their underwriting, they can only go up from there, right? So that question you just asked is, are you nervous about rent going down, right? Well, no, because, here's the thing. You're typically supposed to underwrite at 3%. 3%, that's normal, right? 3% growth, that's historical. You can look at historical rent growth. If you underwrote at 3%, it's always going to go up because it's got to keep up with inflation, right? But the reality is when we underwrite deals at 3 to 5%, when the market's at 14%, it's at 12%, guess what? We're going to maximize that as we can do it, right? We're going to try to get as much out of the first year as we can. Just like the property we closed in December, that we're seeing 3-year numbers right now, So anyway, yeah, that's exactly how we do it to 44%, guys. We look at it, we forecast, we ramp up rents, we make sure that we protest taxes, right? And we take advantage of where we're at. We improve the community with what we're doing. So the people want to stay there. They want to continue to raise their family there. We want to continue to raise rents in those markets. So I'd love to answer any questions for you guys, but like I said, assure this, right? In the deals that we have in the fund right now, we currently have 2 and a third one being added, and more deals being sent to us on a daily basis. Why? because we have a good reputation with brokers, with lenders, and they continue to bring us deals because they know we can close on it. We have great investors in you guys, but that's because we're able to get the returns to you guys like we talk about, and so 2 out of 3 deals that are in there already have been underwritten over 30 times. Like I said, one of them 38 times. And we've done our homework for you guys, right? And making sure those investments are going to be there. So what questions you guys have, I'd love to spend a little bit of time and go over those questions you all may have.
So
someone
really
just asked
quick.
this. Yeah.
Go ahead.
Do we get depreciation K1 year 1? Yeah, absolutely. What are the tax benefits, Daniel? Absolutely. We do a or cost segregation, bonus depreciation. This is the last year, guys, 2022, where we get 100% of bonus depreciation. Let me tell you about one of the properties we did. We raised $8.5 million for it. The study came back, Daniel, on that at almost $7 million. So it was almost for every dollar you invested, you got almost, I think it was 90 cents, depreciation for every dollar you did. So what does that mean to you? If you invest 100,000 or when you invest 100,000 with us, right? That would be a $90,000 in depreciation that you would have seen on that specific property. So is that good? Yeah, right. If you're making money, if you're looking to passively invest, right? You guys want that depreciation. Who wants to pay taxes, right? That's the benefit of doing a study on that. So yeah, that flows down to you in the first year there, Daniel. You get K1s every year, but you'll see a huge tax depreciation in that first year. Great question.
Ryan, really quick, Anastasia asked, 44% ARR, is that sustainable?
Listen, do we have properties? Who asked that question?
Anastasia,
great question. Are all of our deals at 44%? No, I listen, right? We believe in transparency, right? No, some of them have been a total return of 20%, right? Over a couple of years, right? Man, listen, did we learn lessons? Absolutely, right? Absolutely. Did we learn lessons? For us, it's very important who to partner with. For us, doing research of who we partner with is extremely important to us. And on that specific property, we didn't partner with the right people. And we've learned our lesson from that. For us, MF Capital Partners, we have very few people I know someone said, when you get more successful, your circle of influence is smaller. And we've experienced that in the investment side, right? We trust in what MF Capital Partners can do. And we keep it a very small circle. So is that sustainable? If we underwrite correctly, yeah, you're going to see deals, Anastasia, that are 60% annual rate of return. You're going to see deals within the fund, they're going to be 30% annual rate of return. But guess what? Those deals that aren't as big probably will cash flow a little bit better, right? There's reasons for that, right? There's not a lot of upside on the back end because they cash flow a little bit better. Why is it important within the fund to make sure that we do that? Is so that you're also getting cash flow, just like what you guys said you wanted. You want both. Are you greedy? Are you selling? No. Come on, we all want both. We invest our money into the deal as well, right? And so we have to have deals in there that cash flow. Also, we have to have deals that have great equity. So you'll see deals that are 60%. Hopefully I answered that question.
Ryan, do investors have any control over which deal they invest in?
Listen, Kieran, part of the great thing about a fund is you're investing in us, right? You're trusting in our decision. I think that you're asking that question because you've either invested before or you've seen other funds. I have a good friend, Doug, that's in the, I don't know if Doug's on here. If he is, say hello, Doug. But Doug said, hey, because you're going to a fund, are you just going to start going after things? Sometimes you see that your criteria changes, right? That your criteria changes. Does it change? No, right? Our criteria is still the same. We're very selective in what we put our money into, or we put your guys' money into and we invest, right? Very selective. Why? Once again, we invest our own money into the deals as well. So we're selective. We're not going after deals that maybe are 18 to 20% annual rate of return, but now we're at, 15% rate of return because now we have capital to be able to go over, to be able to go after deals. No, our criteria stays exactly the same.
Awesome. Okay. So the next one was the asset past performance over what period?
On the 44% is over a 2.5 year period. That's our average hold time on most of our properties, Octavio. So it is 2.5 years is about the average that we hold a property. Why? Because we're looking at the 18-month period of selling off. If we can get you a return, let's say a total return in a 2-year period, and we put it on the market, typically takes 3 to 4 months to sell. If we can get you a return of 50, 60% there, Now we can take that and put it in a deal that has better value add opportunities. Now we can take your capital, right? As we sell off properties within the fund, what do we do with that? Well, you're going to reinvest it with us again into another fund that we will have, right? And then we'll take that. And what's that mean? That means more cash flow for you guys, right? So yeah, it's 2.5 years is our average hold time.
Awesome. And then I know we want to be respectful of your guys' time. So I think we've answered all the questions. I tried to man that, but we have one more from Anastasia that says, you mentioned protesting taxes. Can you please share an example of how much you were able to save?
Yeah. So we were one of the taxes. If you schedule it here, I don't want to misquote Anastasia. So if you you can do typically 10, 15, 20%, depending on how good your attorney is, right? And so if you don't mind emailing Melissa or scheduling some time with her, I can get you a specific example.
Perfect. Okay. And John, I did see your message about investing through a solo 401k. Yes, we have done that before. We have partners that we can partner you with. So if you want to schedule a call, we can look at your specific situation and get you started. Okay, there's a couple other questions coming in now. Let's just do one more. Ryan, it says, in fact, I'm going to address, we've had quite a few people ask if a 1031 exchange is eligible within the fund. So you can't do a 1031 exchange specifically, but to mitigate that, we have quite a few different strategies that we use and we have in place in order to help you with your capital gains. So if you want to schedule a call, I'm more than happy to go over that and let you know what strategy we are implementing on each property specifically. And we have lots of investors that move instead of doing a 1031 exchange, they invest in our fund, and we have the option to mitigate that risk or mitigate those capital gains. So schedule a call and I can kind of explain that specifically. But the last question is, do you always sell or refi and return our investment and then still cash flow until the fund is sold?
I'd love to answer that question, Daniel, right? It's important to know because here's the thing, the way the funds are set up is that you can do a return of capital, right? You can sell it off, and then what happens? The fund keeps the rest of the properties. So let's say that we sold 2 properties of 5. We sold those off and we're able to get you the return of capital and return that you want, right? Typically what happens though, those fund owners would keep 2 or 3 properties. That's not the case in this fund, right? We win with you guys, and we reinvest with you guys, right? So the reality is we'll sell our properties and do a return of capital at that time, right? And then what we'll do is hopefully you put that money into the next fund with us, right? But we will continue to cash flow until the last property in that fund is sold off. So it will definitely cash flow throughout that. But also, right, the market that we're in, depending on what type of loan it is, right? Would we look at the market? We talked about forecasting always. Would we look at rates and what's going on with the rates, after owning for about a year period of time and see where we're at? Absolutely, right? And as we stabilize the property, we can get better lending on the property, right? The lending, sources that we have after we stabilize the property are much greater, right? So we can get, better rates at that time. And so, yeah, we may refinance, Daniel, after a year period to see where we're at and do a return of capital at that point, but definitely cash flow until the fund is sold out.
Perfect. Well, we're so grateful for you guys. We really love doing these webinars. It gives us the ability to answer all of these questions instead of answering them one by one as you guys email them in. So please continue to jump on with us. We promise to continue to do these. I would love if you guys could email. In fact, Jackson will put our support at MF Capital Partners or investor relations at MF Capital Partners. We would love for you guys to send in some topics or questions that you would like us to tackle and make sure that we're getting you the kind of information that you guys actually want. So again, thank you so much for coming. This is why you guys are our priority. We really couldn't do what we do without you. So you'll remain one of our top priorities. But we're so grateful for you. We're grateful for you, Ryan.
And I want to say this, hey, we'll continue to do these webinars, right? And the thing is we're going to provide some education, but we want to make sure that, guys, we realize in the market that we're in today is people are looking for solid investments, right? And so Jackson's put a link in there for you guys to go in and fill out if you guys want, to either talk to Melissa or if you guys know that you want to invest, right? There's a link there as well. So look forward to talking to each one of you guys in this. Look forward to having you invest with us in the Akahi Fund.
Thanks so much, you guys. Thank you so much, Martin. Thank you, Flower.
Thank you, Melissa.
Flower
Thank you,
Hour.
everyone, for participating.
Thanks, you guys. We'll see you on the next one.